All right, so we were talking about tax. And if you recall, we said that there are three scenarios: accounting equal to tax, and that we looked at last week. That's where you do the current tax calc. And we spent some time last week doing current tax calcs, and in fact we did the current tax calc in the assignment, which I think had a mistake in it. Which did have a mistake in it. We need to go back and look at that. And then we had deferred tax. We had where accounting is not equal to tax, but it is temporary. And that deferred tax, and we're going to look at deferred tax today. And then we also looked at we're going to look at where accounting is not equal to tax, and it's permanent. My goodness. And those are exempt items. And those ones we're going to look at. We did look at some of those when we did the current tax calc, but they pop out in the tax, recon, which we'll look at next week. So today we're going to look at deferred tax. What is deferred tax, and how does deferred tax work? Because last week we covered this, and so this week we're going to look here, and then next week we're going to look at that one. Okay. So what is deferred tax? How does deferred tax work? The first thing I need to tell you about deferred tax is that deferred tax, we do a calculation which is a financial position calculation. So when we do the current tax calc, the current tax calc is like a P&L for tax, do you agree? Getting you to an expense amount. When we do the deferred tax calc, the statement says you must follow the financial position approach, which means that when we do deferred tax, we're calculating the balance on deferred tax. This SFP calculation is going to tell us whether I have a liability or whether I have an asset. Yeah? Whether I have a liability or an asset. This deferred tax calculation looks like this. So whenever you get asked to do a deferred tax calc, you're going to set up a table, and that table looks like this. Carrying amount minus tax base equals temporary difference times minus 28%. I'm going to explain to you why I say it's minus 28%. Look how funny my minus looks. It looks like a little... times minus, now it looks like a even worse kind of squiggle, times minus 28% equals deferred tax. Okay, so that's your calculation. Carrying amount minus tax base equals temporary difference. Temporary difference times minus 28 equals deferred tax. What are these numbers? Carrying amount comes off your financial position. And in fact, in practice, when we do deferred tax calculations, to make sure that we've left out no temporary differences, we actually pull down the entire trial balance. All the assets, all the liabilities. Yeah? We don't do equity. Equity is just assets minus liabilities. It doesn't have tax. So all the assets, all the liabilities. Okay, those are just your carrying amounts straight from your financial position. Whatever's sitting on your financial position, that's the amount that comes in there. Tax base is the same number, but for tax. It's the tax carrying amount. Yeah, it's called the tax base. There are two, when we're calculating tax bases, we get tax bases of assets, and we get tax bases of liabilities, just like we have carrying amounts of assets and carrying amounts of liabilities. I'm going to give you the definition of tax base, and when we look at the examples, we're going to always refer back to definition. However, as you get used to doing deferred tax calcs, you will eventually just know, oh, that's the carrying amount for tax. Okay, so what is the tax base of an asset? The tax base of an asset is the future deductions that you're going to get on this asset. Future deductions. So if we're looking at something like PPE, the tax base of a machine is the amount of wear and tear that I'm still going to get on that asset. So in other words, it's the cost less any wear and tear I've already been given, giving you a balance, which is the wear and tear that I will be given in future. So the tax base of an asset is the amount of future deductions I will get from that asset. Okay. For liabilities, there are two types of liabilities. There's an expense liability and there's an income liability. Yeah, so let me give you examples of those two. An expense liability is something like a provision for warranties or a provision for leave. SARS does not give you the tax deduction when you provide. Last week we saw in the assignment question a provision for cancellation of a lease. Do you remember that? We added it back in the tax comp, didn't we? Because SARS will only give you the deduction for a provision when you pay it, not when you provide for it. So provision is an example of a liability. It sits in my financial position, provision for cancellation of lease, but and it is expense related. Okay, a liability that's income related is income in advance. If I receive some income in advance, as you know, it's taxable. For tax, I pay, it's in my tax calc. However, for accounting, it sits in my financial position as a liability, isn't it? Income received in advance. Okay, so what are the definitions then? The definition of the tax base of a liability when it's an expense is carrying amount minus deductions allowed in future. Carrying amount minus deductions allowed in future. And we're going to look at them when we look at the examples, but I take the carrying amount of the liability, the amount that's there, and I ask myself how much of this will be allowed as a deduction in future, and I subtract it to get the tax base of a liability. The definition of the tax base of a liability, if it's income related, is similar. It's carrying amount less amounts not taxable in the future. So if you look at that one, it's expense, it's carrying amount, less amounts deducted in future. This one is income, it's usually the other way, income, isn't it? Is carrying amount, less amounts not taxable in future. Because expenses are deductible, income is taxable. Okay. So that's tax base. As I said, as we start, we will always go, okay, what was that definition again of tax base of a liability if it's expense, so that you're able to calculate that amount. As we progress, it will become easier and easier to do. The one minus the other gives me a temporary difference. That's the difference between P&L and tax calc. Yeah, last week we talked a little bit about that. There are two types of temporary difference, just in case you see them talked about in questions. There are taxable temporary differences and there are deductible temporary differences. So the statement talks about a taxable temporary difference and a deductible temporary difference. The taxable temporary difference results in a liability. Do you agree? An increase in a taxable temporary difference will result in a liability. A decrease will result in a liability being reversed. Yeah? A deductible temporary difference results in an asset. An asset. So an example of a taxable temporary difference would be when I get given a lot of wear and tear up front and I depreciate slowly. I'll end up with a taxable temporary difference. Why? In future, I'm going to pay more tax. Because I've been given lots of wear and tear allowances in the beginning, there'll come a time when there won't be any more wear and tear allowances, but I'll still have depreciation, and then I'll have to pay more tax, right? A deductible temporary difference, like on this provision. In future, I will get a deduction for this provision, but I've already expensed it, so it's an asset. Okay, so taxable temporary differences, deductible temporary differences. When you get especially to honors level, they sometimes, you'll see that at third year level, they give you all the detail. You'll get the detail of the different kinds of assets that have temporary differences, and you're able to do a full calc. Sometimes when you get to honors, they don't give you all the detail. You're unable to do a full calc. But they'll say to you, the taxable temporary differences last year was this, and this year is this. So you can see the movement, isn't it? And the movement is what lands up in your tax calc. Yeah? All right. So carrying amount less temporary tax base is temporary difference. And then I multiply the temporary difference by 28%. I'll explain to you why I say minus. Because obviously we're going to land up here with deferred tax assets and deferred tax liabilities, isn't it? And the statement also, or UNISA, has this thing where they say, if it's an asset and the carrying amount is bigger than the tax base, then it's a deferred tax liability. If it's this, it's a it's a that. But you don't need to know that, because if you follow the approach that I'm going to show you to do the calc, and you multiply by minus 28, you will always get the correct asset or liability here. Okay. All right, so let's have a look at some examples of calculations of deferred tax. The first one we have is in your study guides. It's example 2. If somebody can find a page for me. It won't be right in the beginning because page 30. Page what? 14. 14. Page 14. Okay, so a manufacturing plant was purchased 1 January 12 at a cost of 120. The depreciation for the year was 24 and the tax allowance was 40. The company has been incorporated in the current year and has profit, wada. Okay, here's my deferred tax calc. Carrying amount minus tax base equals temporary difference times minus 28% equals deferred tax. So, carrying amount. Plant was bought for 120, depreciation of 24, carrying amount 96. All agree? 96. Tax base. Cost was 120. I've been given allowances of 40. So the remaining allowances are 80. Remember, tax base of an asset is the future deductions on that asset. It's the wear and tear that's going to be allowed in future. I land up with a 16. I multiply the 16 by minus 28% and I get 4.48, and it's a deferred tax liability. Yeah? Why is it a liability? Because I'm being given accelerated wear and tear. The wear and tear allowances at the moment are bigger than depreciation. It means that my taxable profit is less than depreciation. Do you agree? Because if we look at what they said profit before tax was 100. But then I'm going to add back depreciation and I'm going to deduct the wear and tear. So I land up on 86. Is it 86? No. What was the thing? 24 and 40. No, it's 84, isn't it? Oh my goodness. Now it's writing with it. There. So look, even though my profit was 100, I'm only paying tax on 84. Yeah? There will come a time, if I continue the depreciation in this manner, that my profit before tax will be a certain amount. I will still have depreciation to add back, 24, but I won't have any more wear and tear to deduct. And in that year, the tax will go the other way. Do you agree? My taxable income will be bigger than my profit eventually. So this 16 represents less tax that I paid this year. And so therefore, I have a liability because there will come a time in the future where I will pay more tax. Yeah? But this is the calculation that you need to know. And I think, I don't want to talk too much about how deferred tax realizes and unravels, because I think it's something that it's difficult for you to conceptualize right now. Right now, all I need you to do is to say, okay, this is the calc, this is what I have to do, it's financial position, what's carrying amount, what's temporary difference, what's tax base, what's temporary difference, what's my deferred tax, is it asset or liability? Because then, as you do it, it will start to click into place. Okay, but for now, carrying amount we agree with, tax base we agree with, temporary difference, minus 28%, 4.48 deferred tax liability. Okay, so this is an example of deferred tax on an asset. My next example has to do with a non-depreciable asset. A non-depreciable asset, because I just want to show you how you will deal with that. So this example 3 says, on the 1st of January, A was incorporated and they bought a manufacturing building for 2 million and an admin building for 500,000 Rand and land for 300,000 Rand. So I have 3 things. I have a manufacturing building, I have an admin building, and I have land. Manufacturing building was 2 million. Admin building 500, land 300. Yeah, on incorporation, which was 1 January 12. Land is not depreciated and no tax allowance is claimable. The manufacturing building is depreciated at 4% straight line and SARS allows 5% annual allowance on this building. So accounting is 4%. What's 4% on 2 million? 80. Do you agree? SARS allows 5%, so their deduction is 100. Yeah? For land, SARS doesn't give an allowance, and neither do we. We don't depreciate land. The admin building is depreciated over 20 years. So if I divide by 20, it's 25. So the admin building is depreciated over 20 years. But no tax allowance is claimable. That, I'm sure you know from tax. Admin buildings are not considered to be in production of income. So therefore, there's no tax deduction on admin buildings. And so you don't get an allowance. What you will get on an admin building is if you then sell the building at a later stage for less than what you paid for it, you get a capital gain credit, a loss, that you can use to offset if you had capital gains, profits in future. All right, so that's the story. Agree? All right, so I'm assuming it's the end of year 1. Is that what it is? It doesn't say. But yeah, I'm assuming it's the end of year 1. And so when I do my deferred tax calc, carrying amount minus tax base equals temporary difference times minus 28% equals deferred tax. I've got 3 types of assets this time over here. I have a manufacturing building, an admin building, and land. The carrying amount of my manufacturing building is 1920. Agree? That minus that. The carrying amount of my admin building is 475. That minus that. The carrying amount of my land is 300. Yeah? The tax basis. The tax base on my manufacturing building, I get an allowance, do you agree, is 1900. Now the next 2. What is the tax base of my admin building? What is the future deductions that I will get on my admin building? 0, isn't it? And what is the tax base on land? 0. Okay. So now I get to temporary differences. Temporary difference here is 20. Now, the next two are interesting. Is accounting ever going to be the same as tax for the next two? No. Do I have a temporary difference? No. What I have is an exempt, isn't it? I have an exempt. I have an exempt there. Why is it that when I write there, it doesn't write there? I think it's because I'm standing. I have an exempt there, and I have an exempt there. Yeah? No temporary differences. But now, there sometimes are marks for you to put those items in and then show that it's a 0 and there's no temporary difference and there's no deferred tax. Yeah? And when you get to 3702 and we do revaluations, on revaluations there is a deferred tax implication because it's capital gains, isn't it? So if this number here had a reval on it, there would be a piece that would be capital gains, but only a piece. Yeah, so it's a bit of a funny. And the same with land. So here the only temporary difference we have is on the building, and times minus 28% is 5.6. And again, it's a minus, right? Minus 5.6 is my deferred tax liability. Okay, so that is so that's an example of a depreciable asset, and in this case, not really the depreciable asset, but an example of a depreciable asset where you don't get tax allowances, and a non-depreciable asset, and how they appear in your deferred tax calc. All right. The next thing we have is example 4, which is again an asset. It's a prepayment, an asset which is a prepayment. Assume that the company paid insurance in advance of 1,000 rand, a prepayment. Let's do a quick tax or deferred tax calc. Carrying amount minus tax base is temporary difference times minus 28% is deferred tax. If I have a prepayment, my balance sheet or my financial position has an amount of 1,000 rand sitting as an asset, prepaid. The tax base is the future deductions. What are my future deductions on this prepaid? 0, huh? How much was allowed already? The full 1,000, eh? Because SARS allows you the full amount when you pay the insurance. So SARS has already allowed that 1,000. He's not going to allow it again. So the future deductions are 0, leaving me with a temporary difference of 1,000, which times minus 28% is a deferred tax liability of 280. Why is it a liability? Because in future I will pay more tax, because I'm going to put this 1,000 into profit before tax next year as an expense. My expense will drop. If you think about what will happen next year, here's my 5,000 profit before tax. I'm going to put this in. My expense drops to 4. But then when I do my tax calc, I start with 4 and then I say, no, I can't deduct the 1,000. I already got the deduction for the 1,000, isn't it? And I've got to put it back in. And then I land back on 5. So this will be the number for accounting. This is the number for tax. And you'll see that in future I will pay more tax. When I pay that extra tax in future, then this will disappear and it will reverse. So this is another example of a deferred tax asset for a prepayment. So now we've seen 3. We've seen a PPE, a depreciable asset. We've seen a depreciable asset where there's no tax allowance, the admin building. We've seen a non-depreciable asset, the land. And now we've seen a different kind of asset, a prepayment. The next example we have is example 5, if I imagine correctly. And example 5 is a liability now. and it's a liability that relates to income. Revenue received in advance is not accounted for. Okay, wada. This is the piece that I want. A company has been incorporated in the current year and has received deposits in advance of 20,000 Rand from their customers to book holiday accommodation. The accounting profit was whatever for the year. So, carrying amount minus tax base equals temporary difference times minus 28% equals deferred tax. I now have a liability. I have income received in advance. It's sitting in financial position. It is a liability, and so therefore I'm going to put it in a bracket. Yeah, in a bracket. Then I say, what is the tax base of a liability? The tax base of a liability is the carrying amount, 20, less any amounts which are not taxable in future. How much is not taxable in future? All of it, 20. Why is that? Because it's already been taxed, isn't it? It's already been taxed. So therefore, my tax base is 0. It's already been taxed, my tax base is 0. From SARS's perspective, there's nothing sitting on the financial position, correct? It's all gone. So 20 minus 0 gives me a temporary difference, and it is a negative temporary difference of 20. When I multiply a minus by a minus, I get a plus, isn't it? So I get a plus, is it 5,6? A plus 5,6. And this plus 5,6 is a deferred tax asset. Is it correct that I should have a deferred tax asset? Yes, it is. I've paid tax in advance. Next year, this 20,000 is going to be in my P&L as income. And I don't have to pay tax on it, isn't it? So when I calculate the tax, I'm going to deduct it and say I've already paid tax on it. So that's my deferred tax, and you'll see that you can see it flips, isn't it? And it becomes an asset. So this is an example where we have income liability, and this next example is where we have a expense liability. A company was incorporated in the current year, and they sell vacuum cleaners with a 1-year warranty. The company provides for the warranty, and the total provision for the year was 150. Assume that the profit before tax is 500, and the tax rate is 28%. SARS will allow the warranty costs as a deduction once they're incurred. Okay, so carrying amount minus tax base equals temporary difference times minus 28% equals deferred tax. So I have a provision at year end, 150,000. It's a liability. It sits in my financial position as a liability. It has a bracket. Okay? It's something that I always do. When I do trial balances, I always make debits a plus and credits a bracket. Yeah? Then you're very clear which way you're working. So it's a bracket. Tax base of an expense starts with carrying amount, 150. The tax base of a liability is the carrying amount less amounts that will be deductible in future. How much will be deductible in future? The whole amount, isn't it? Assuming that your provision is correct and that these warranty costs come true, and that when you actually have these warranty expenses, it costs you money, labor, overheads, whatever it is. Then you will get the future deduction. So therefore, your tax base is 0. And so your temporary difference is minus 150. And so your deferred tax is 42. Is 42,000. And it is a deferred tax asset. Yeah?
So do you always assume that you're going to use the whole provision?
We assume now, yes. What will happen if you don't use the whole provision? So two things will happen. There are two scenarios. Either we use the whole provision and then SARS will give us the deduction, in which case then accounting is equal to tax because we've put 150 in our P&L at some point. We spent the money and SARS gave us 150 as a deduction sometime later. Or we don't use the provision. What will happen then? In my P&L, I will reverse it, isn't it? And so I will reverse it in my P&L if I never use the provision. And then the year that I reverse it, then my profit will go up, back up. But it won't affect tax at any stage because when I first raised the provision, I added it back for tax. When I reverse the provision, I will deduct it or whatever for tax. It will not have a tax implication at all because it's just a movement in a provision. And you saw from last week when we did that provision movement, hey, movements in provision, we just reversed. Remember that 5? We just reversed. Movements in provision, we reverse because that's not what tax does. And then we look at what does tax do. What does tax do? Tax allows you the deduction when it's paid. Yeah. So whatever the movement is in the provision, we just reverse that.
So if they gave you the scenario, they said out of the 150 you used 100. Then when you took 150 minus 150, you get 150 minus 100.
What will happen then is, no, your tax base won't be 50 because in the year that you use the 100, you will reverse the 50, yeah, and you will pay the 100. Your liability here will be 0. And here will be 0. And then that will be 0. And it will disappear. Yeah? Because you would have started with a 42, you end with a 0. So that movement goes into your, I'll show you what happens with the deferred tax, but it lands up in your P&L as an expense or an income. Whichever way. All right, so that's example 6. Let me just see what was example 7. Why don't you want to go forward? I have any more things there? No, I do. I skipped example 7. Okay, example 7 in your books is an example of a lease. It's something you're never going to come across in FAC3701, an installment sale and a lease. It's like a lease. So I usually just ignore that example. When we do leases, which we do in FAC 3703, then we'll cover the deferred tax on that. It's not something you're going to come across in 3701. Okay, so the last thing I have is actually, you know, we've been seeing numbers that are on the financial position, which have carrying amounts, which have 0 tax bases, isn't it? Prepayments, provisions, income received in advance, all have 0 tax bases because SARS does not defer amounts. They don't do like accrual accounting. So if it's paid, they allow it. And when you pay it, they allow it, isn't it? So they don't do like us where we put amounts onto the financial position for prepayments or for accruals or provisions or whatever, or defer income. Now we're going to see one where there's actually no carrying amount, but there's a tax space. And I'm talking about an assessed loss. An assessed loss. Okay, because if we look at what an assessed loss is tax that we're going to pay less of. No, let's not say tax, let's say less tax. An assessed loss is less tax paid in future. Do you all agree with that? Less tax paid in future. I've had a loss in the current year. So if we look at this example, they say to you, a company's been incorporated in the current year and the profit before tax was 20. Included in profit is 10 of depreciation and tax allowance of 40. So I start with profit of 20. Then I do the adjustment for depreciation and wear and tear. So I start with profit of 20, I add back the 10 and I deduct the 40 and I land up with a tax loss of 10. Yeah? That tax loss, you can see, SARS doesn't give you money back when you have tax losses, isn't it? If that was income, he'd say, times 28%, pay me. But when it's a loss, he takes it and tucks it away. Then next year, when we make profit, he'll say, okay, hang on, you have that loss from last year. I'm going to allow you to deduct that off your profit so that you pay less tax. So an assessed loss is less tax paid in future. If you look at this, less tax paid in future, this is the definition of the tax base of an asset. Do you agree? If you remember what the tax base was of an asset, the tax base of an asset is amounts deductible in future. This assessed loss is an amount deductible in future. So when I do a deferred tax calc for this assessed loss, it looks a little bit like this. Carrying amount, 0. Minus tax base, 10. Temporary difference, minus 10. 0 minus 10 is minus 10, isn't it? Or a bracket. Deferred tax, 2.8 asset. I'll end up with a deferred tax asset. Yeah? So, assessed losses result in deferred tax assets. They go onto my deferred tax calculation. You know, I've been doing separate tax calcs all along. But when you do a deferred tax calc, it's one calc. All those numbers that we've been seeing in the different examples would appear on one calc, including at the end of that calc then, the assessed loss. Any assessed loss at end of year lands up in your deferred tax calc and becomes an asset. Okay, so let's talk about, let me see what I've got here, a blank, perfect. Let's talk about this deferred tax asset. A deferred tax asset. So we've just said that deferred tax assets can arise as a result of assessed losses. Do you agree? An assessed loss can create a deferred tax asset. If we go back to framework, framework says an asset is only recognized if there are probable future benefits. Do you agree with that? Probable future benefits. It was framework recognition criteria. If you remember from second year, framework says you can only recognize something if it's probable and you can measure it reliably. So, a deferred tax asset only meets framework criteria to be recognized if the future benefits are probable. So, therefore, when we land up with a deferred tax asset, it is very important, that there must be anticipated future profits to use the assessed liability / deferred tax asset. So you need to look in the question if you land up with a deferred tax asset once you've added it all up. Yeah? Once you've added everything up, if you land up with a deferred tax asset, you must check if there will be future profits to be able to use that deferred tax asset, that assessed loss. If not, then you can't recognize a deferred tax asset. So, else, null will be your deferred tax balance. Okay, so whenever you do a calculation or question and you land on a deferred tax asset, you must go back and ask yourself, or check the question, really. In real life, we ask ourselves or we ask management. In the exam, you're going to check the question. What does the question say about future anticipated profits? Is there sufficient certainty or probability, because we're looking for probability, isn't it, that those future profits will exist? If the answer is yes, then we leave the deferred tax asset because we met criteria. It's fine to put an asset onto our financial position. If the answer is no, we cannot recognize an asset, and so the deferred tax will be zero, null. Okay. So this is just something that we don't really see at third year level. I think I remember seeing it once, but at honors level you see it a lot. In 1 year then they say no you can't, and then the next year they change their mind and they say yes you can, and you're flopping like that back and forward. But that's an assessed loss. Right. So, this is what you will do for deferred tax. You will do a calculation which will be a deferred tax calc, carrying amount minus tax base equals temporary difference, times minus 28% deferred tax. You will do a deferred tax calc at end of year, and it will give you the balance at end of year, statement of financial position. Yeah? Now, you will also do the same calc, carrying amount minus tax base equals temporary difference times minus 28% is deferred tax. You will do the same calc at beginning of year, and you'll have a balance which is beginning of year. And the reason for that is because we need to work out a movement. And the movement in deferred tax is what then goes into P&L. The movement in deferred tax is what goes into P&L. So there are a couple of ways to do this movement calc. I'm going to show you the three, and I'm going to tell you which one I think is the best, and then I'm going to leave you to decide for yourself which one you're going to do. Let's assume, not for simplicity, let's assume a more difficult one. Let's assume that at beginning of year, over here, we had a deferred tax asset of 120. And let's assume that at end of year, I'll end up with a liability of 250. Yeah? So, the first method, which is a method that one of my honor students once used to say to me she used and she preferred, is to use almost like a timeline. There's 0. There's 120 plus. Do you agree? Here somewhere is minus 250. And if I need to go from 120 to minus 250, my movement is a movement that way, yeah, of 370. Yeah? And the movement is a negative movement. Do you agree? A negative movement. So therefore, it's an expense. Do you agree? An expense. It's a minus and it's an expense. So that's the one she liked to use. The one that you will see in the UNISA notes is a tabular, vertical sort of format where they say deferred tax asset end of year. Sorry, not asset. Deferred tax end of year, 250. And then they say less deferred tax beginning of year, minus 120. No, let's put credits in brackets. 250 minus 120, like that. Do you agree? Balance at the end, 250 liability. Balance at beginning, 120 asset. But I'm minusing an asset, so I'll end up with minus 370 as my movement. Do you agree? Expense. Now, this one has the risk that students will go, oh, I'm moving from 120 to 250, the movement's 130. But the movement's not 130, isn't it? The movement goes to a 0 first and then to a minus. So I start with end of year and I subtract beginning of year to get my movement. The option that I prefer is a T account. So the one that I like is a T account. And you will see whenever I do calcs or we do questions, I will say, oh, here's my T account. Because whenever we do deferred tax, that's why deferred tax is usually a lot of marks. You have to do a deferred tax calc at end. You have to do a deferred tax calc at beginning. Although sometimes this number is given. They'll say to you, deferred tax at beginning was this. And then you have to do the movement to work out what lands up in your P&L. So if you do a T account, we have an opening balance, beginning of year, and it's a debit of 120. And then I have a closing balance, and remember your balances are carried forward, brought forward, isn't it? So in order to bring it forward on the credit side, the carried forward balance at end of year is on this side, and it's 250. And so therefore to balance this account, yeah, I need a credit to this side of 370. And if I'm going to credit this side with 370, it's therefore a debit in P&L, because that's T accounts, right? So to balance the account, I need a credit. And because I need a credit here, this account here is in the financial position. Because I need a credit here in financial position, because this is a credit in financial position, it will be a debit in P&L. So that's my favorite, this one. This is the one that you see Unisa do all the time. And this one is the one that a student of mine used to do, because she just used to say it made sense to her. And obviously if your arrow is going that way, you're going backwards, so it's an expense, it's negative. And if the arrow is going the other way, it's a positive, so it's income. And deferred tax in your P&L can either be a debit or a credit. And it's a debit or a credit because of those temporary differences that are either arising or reversing, and are either taxable or deductible, isn't it? But you don't need to worry so much about that terminology. For you, I've taught you how to do a calc. You will have a calc at beginning, a calc at end, and then the movement. Yeah? All right, there's just one more thing I need to show you with movement and with deferred tax before we look at this assignment. So I didn't have enough pages. Okay, and what that is a rate change. What happens when there's a rate change? And in fact, there's a rate change in our assignment, isn't it? I seem to recall a rate change in the assignment. So if this is my T account, and I'm going to just use the same T account that I was using before, beginning of year a 120 balance, and then end of year a 250 balance, which is a carried forward, because then it will bring forward on that side. Yeah. If, and sometimes there's this thing called a rate change given in the question. What the statement says is that if a tax rate change has been promulgated, right? Promulgated. In other words, it's been approved by government, then you must put that change into your financial statements, okay? In this country, we assume that promulgation to be the finance minister's speech that he does in Parliament, which is coming up soon, I think, usually happens now in February. When and if the minister announces a rate change, then do you agree that the rate change affects deferred tax? Because deferred tax is tax which is payable or deductible in future, isn't it? It's future tax. So therefore, if I have temporary differences and they are future tax, those temporary differences will now be paid at the lower rate. Agreed? Okay, so let's assume for my example that the tax rate is going from 28%, I'm just going to go the other way, to 30%. So if the tax rate is going from 28 to 30, if I analyze these temporary differences, this temporary difference was something which at 28% gave me 120. Do you agree? So how do I get to that something? I divide by 28%. Okay, so if I take the 120 and I divide by 28%, I get a really ugly number. But so be it. 428. I should have thought of it before I did the example. 571. So 428571, when I multiply by 28%, I get 120. Yeah? Okay. Now, if I'm preparing financials and the minister announces a change in the tax rate and he says, no, hang on, we're going to change the tax rate and you're actually going to pay tax at 30%, do you agree that this number is incorrect? Yeah? That number needs to move. Needs to move by the 2%. Yeah? So I need to make this balance bigger by the 2%. So that's the first thing that I'm going to do, is I'm going to say rate change and I'm going to make the balance bigger. If it was the other way, the rate change, it would go on this side to make the balance smaller. Okay, so there's my 428,571, and I'm going to times it by 2%, and it's 8. Is it really 571? 8.571. Now, when I do my balancing, you'll see that my P&L is going to grow by that 8,571, isn't it? To make it all balance. So whereas before my P&L was just 370, my P&L now is 378,571. Yeah. However, the rate change also lands up in P&L. And so my net P&L is still the 370 that I had before. Okay. However, the reason that I split it like this is for disclosure. Because when I disclose the movement in deferred tax, I will say the movement in deferred tax is made up of a rate change which made deferred tax go up by 8,571 and a movement in temporary differences which made the rate go up or come down or whatever. It made my asset go up and then it made my asset come down to a liability of the other way. Yeah. So my movement is that minus that, which is the net 370. Why do I need to bother with this then if the movement is still 370? For disclosure purposes. Okay. All right. I think what I have next is the continuation. Oh, what happened there? Oh, no. I think I went backwards. I don't know if nothing seems to work today. I can't seem to move pages. All right. So this was the written assignment we worked on last week. Before I do that, I wanted to show you an example of what that holistic like presentation and disclosure example. So if you have a look at I want to show you one with real numbers. Okay, have a look on page 52. On page 52 is a note for income tax. Do you see it? And it says, major components of income tax, current tax expense, current year, under provision of prior year, and then deferred tax expense, current, and rate change. And there's also goes the other way. Do you see a plus and a minus? So that's what ours would look like, isn't it? Deferred tax expense, current expense would have been, oh, come on. Current expense would have been that, because we agreed that that was going to go as a debit, isn't it, into our P&L. And then we would have a minus for the rate change of 8,571. Yeah, exactly as it sits there. Then a deferred tax note. So that's the deferred tax, the income tax note, where the deferred tax comes into the income tax note. Then a deferred tax note, an example of a deferred tax note, is on page 48. If you look on page 48, you'll see a note that says deferred tax, and this is a statement of financial position note. The income tax expense note is a P&L note. It shows the movement. But your deferred tax note is going to balance to this number. Yeah? The deferred tax note, when we do it, would balance to this number. Yeah? And all it is a list. So it's a list of all the temporary differences that were in your calc. And they just come on here with the items totaling up to your deferred tax asset or liability. Do you see? Analysis of temporary differences, accelerated capital allowances for tax, that's your PPE, and your prepaid, landing you with a deferred tax liability. Yeah? So that's what the deferred tax note looks like. So if in an exam they ask you to do the deferred tax note, then all you have to do for the deferred tax note is just this calc, isn't it, to get you to your balance sheet number. And then your note is just whatever's in here, and those numbers will go into the note. If they ask you to do an income tax note, then you have to do all of this and the movement, because the number that goes in my income tax note is the movement, the P&L movement in the expense. Okay. All right. So last week we did this assignment. We started with this assignment. So this week we're going to come back, and if we look at what we did last week we did this required A, which was the current tax. And in fact, I think, yeah, we did do that. I have it on the board. This week what we're going to do is we're going to do required B and C. And we're going to start E, which is the income tax note. We're going to be able to do the income tax note as I showed you on that one page, isn't it? Without this tax reconciliation, because we can't do the tax reconciliation yet, but we can do the rest. So we're going to do, first of all, B, calculate the deferred tax movement, including the tax rate adjustment in the statement of P&L for the year ended December 15, using the statement of financial position approach, which is this approach that we've talked about, yes? That's the approach that is recommended, that is required by the statement, according to the requirements of IAS 12. Indicate if your answer is a debit or credit movement. So what do we need to do in order to do a movement? Deferred tax beginning of year, deferred tax end of year, T account, or vertical calc, or timeline with the movement. B, prepare the journal entries for tax expense and deferred tax expense. Yeah? So what are the journal entries? It's debit in the P&L and credit a tax liability, isn't it? Or debit in the P&L and credit a deferred tax liability. Then D, we won't be able to do today because D is dividends tax. We're going to look at D next week. But E then is to start our tax note. And we're going to do just that first bit, the bit I showed you, of the income tax expense note. Tax expense note, it says including tax rate recon, which we can't do, and the deferred tax note, which we will be able to do. Yeah, which I showed you those notes. All right, so let's see what we did last week. I don't know why this thing misbehaves like this. All right, if you recall last week, we actually did a calc. And we even identified which ones were temporary differences and which ones were exempt, right? And how this helps you is because all the differences that we said were temporary differences, all of these, we need to see those in the deferred tax calc, isn't it? So if we look at what those were, we had credit losses. So in my deferred tax calc, I expect to see allowance for credit losses, carrying amount, tax base, wada. We see depreciation and wear and tear and loss on sale and recoupment. So in my deferred tax calc, I expect to see PPE, the machine, or whatever it was. I think it was 2. Hey, one was sold. Remember that we're looking at balances at end of year. So if a machine was sold during the year, there's going to be a 0 left on the deferred tax calc, isn't it? So we don't need to do it. And then I want to see the prepaid expenses on the lease, and I want to see the provision for the penalty. So 4 things at least. And I think it's just one asset, because then when they sold those knitting machines, they leased them, isn't it? So that's not an asset anymore. So it's going to be the allowance for credit losses. I think it was a machine or something like that, vehicles, a prepaid lease, and a credit and a provision. That's what I want to see. And last week, one of the students pointed out that I made a mistake with it was the fines and the VAT, because they shouldn't be minus on the calc. If we look at our calc, there was foreign income and dividends received, which I deducted, but then there were expenses which were not allowed, and I should have added them back, not deducted them again. Isn't it? So that was a mistake. And what I should have done with those 2, with the fine and with the interest on the VAT, is those should be plus, because those already were making that number smaller. They were already making profit smaller, those two. And so if I deduct them again, I'm giving myself a double deduction, when in fact I should be taking away the deduction. So it's 18, isn't it? So I have to add 18 at the bottom here twice. You've done it? So this number becomes 906, is it? But do you agree the same thing with the 12, huh?
Yeah.
So we had 870, and I've got to add back 18 twice. So I land on 906, not on 870. And then up here, I will start with 906. And if I subtract 120, I land on 786. No, I mustn't do that. Otherwise, then later we're looking, because this question we're still going to be busy on next week. 786. And then tax on that is 22318. And then if I subtract 175, I get 45318. Okay. If anybody's got any other things they think we need to correct, 45318. Okay, we got carried away with the deducting and adding back, and we went the wrong way. 45318. All right, so this was the tax calc from last week. The number that's going to go into my tax note is this number. Oh, that's ugly. I mustn't do that, because then you can't read it. Undo. Let's do a lighter color, like that one. This one. Okay, so that's the number that goes into my tax expense note, income tax expense note. So that will pull through from what we did last week. And then all these temporary items, you must look at them and you must put them onto a deferred tax calc. Okay, so that's what we're going to do today. I think we had nothing else here really. We had, what was it that else we had? It drives me insane. We had done a little calculation on that provision, and that was it. And I have a blank page. So your starting point, they said to you, is to do the deferred tax movement. When we look at the question, I'm sure they're going to tell us what the deferred tax balance was at beginning of year. Okay, there's a couple of things here. There's a rate change. Okay, so there's a couple of things here that you need to be aware of that are in the question, which relate to deferred tax. The first of them is that the rate changed from 29 to 28, and that there was an assessed loss of 120. Try that one. Okay, so there was a rate change and there was an assessed loss of 120 in the year. And then if you look down at the bottom here, they also say to you here that deferred tax is provided on all temporary differences using the statement of financial position approach. There is certainty beyond reasonable doubt that there will be profit in the future. So this is in case we land up with an asset, right? with the assessed loss. But the assessed loss we've already used, actually. Hey, so that assessed loss is not going to land up in your deferred tax at end of year because we've already used it. And then they say the deferred tax asset balance. So if we landed up with a deferred tax asset, that's telling you that it's okay. But I don't know if we will land up with a deferred tax balance. What I do know is that this assessed loss is last year's assessed loss, and we've used it. We used it in this year's tax calc. So at the end of this year, that balance is now 0. Yeah, now 0 at end of year. Okay, then at the bottom here, we say they tell us that there is certainty beyond reasonable doubt, and then they tell us that we have an opening balance, deferred tax balance, as at December 14 of that, and it is an asset. So an asset balance at December 13 of that. Okay, so you must go and do your calc for 2015 with those items that we talked about. Then we're not going to put in any assessed loss. Then to do the movement, we're going to move from an asset of 39078 to whatever you work out, but to get from the one to the other, we're going to first do a rate change, yeah? And our rate change goes the other way. It doesn't go the way that I showed you. My rate change was making my asset bigger. This rate change is going to make your asset smaller. Yeah? All right. So, you all have the assignment? Did I print it last time? No? Oh, but you have the assignment. You should have it in Title Letter 101, right? Yeah. So anybody who doesn't have can let me know. I'll make a copy, but it's in Title Letter 101, Assignment 2. And we're going to start with the deferred tax calc. And when I say we, I mean you. I don't mean me. The deferred tax calc. I will do it as well, and then once I'm happy that you guys are all more or less on track, and I've come to check and help, we'll check it. I'll put it up on the board, and we'll check the answers. So deferred tax calc, remember, looks like this. Carrying amount, you leave space because you're going to put the items in, right? Carrying amount minus tax base equals temporary difference times minus 28% is deferred tax. And what do I expect to see in my deferred tax? I expect to see credit losses. I expect to see a machine. No, not a machine, a vehicle. The machines are gone. I expect to see a vehicle, and I expect to see prepaids, and I expect to see a provision. But you obviously are going to write it all much neater than me, right? And then I want to see what is the carrying amount in financial position, not the amount that's in your tax calc, that's the movement, the balance in your financial position. What's the tax base? And then a calculation. And we are going to do the end of year, because this is the end of year calculation. You're going to do it at 28%. Yeah? Because last year's one was done at 29, but now we're going to do this one done at 28 because the rates changed. All right, let's do that first. And make sure I didn't make any mistakes, which I have a feeling I might have done. All right, so the first thing we have is the allowance for credit losses. Do you agree? The allowance for credit losses is in my statement of financial position as a credit of 60. Yes. The tax base is the carrying amount, 60. Less amounts that will be deductible in future. Now look, that allowance for credit losses. SARS allows 25%. How much will be deductible in future? 75%, isn't it? So that calculation up there is the 60 less 75% of 60, because that's what's going to be allowed in future. So far, he's allowed the 25. So we left with the 25. Yeah? So that was a tricky one. unless you really had thought through what is that tax base, whatever, you might not have got it. So that amount is 15. Do you agree? 60 minus 15, so plus 15 in other words, is minus 45. At 28% is an asset, 12,600. Agreed? Is that what you got? Okay. Then we have a vehicle. The vehicle has a carrying amount in the statement of financial position of 152,000. The vehicle has a tax base of 120,000. Did you all get that? Carrying amount, temporary difference, 32,000. That one is asset, 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 asset. Converting to a liability of 8960. Yes? Good. Prepaid, 59,400. Do you agree? Prepaid 59,400. 59,400, zero tax base, because remember the asset is future deductions. Future deductions on that prepaid will be zero because we've already been allowed the full amount as a deduction. We were allowed the full 71 as a deduction. Yeah? Yes? The 71 is what we paid, but then we've accounted for 19,800 in our P&L, which was, I think, 3 months. Was it 3 months, 9 months, something like that? So 3 months is in our P&L. The other 9 months is in financial position waiting for next year. So 59 minus 0 is 59, converts into a liability, 16,632. And then lastly, we have a provision for the cancellation of the lease, a minus 80. It's a liability. The tax base is zero. Tax base of a liability. Carrying amount, 80. Amounts that will be deductible in future, 80. Yeah? So, it's unbelievable. Oh, no. $80 minus 80. Yeah? 80 minus 80. 0. 80 minus 0 is 80. It's a liability, a temporary difference, a deductible temporary difference. It's got a minus around it. Yeah? It's a future deduction. And so a deductible temporary difference results in an asset, 22,400. Yeah? I add it up, I get 9,408. Did you guys get 9,408? Excellent. All right. So 9,408 is my deferred tax liability. We now can do the deferred tax note. So that deferred tax note in E, this is your deferred tax note in E. So this is, but this isn't C yet. So let's finish C. But when we come to E and you have to do the deferred tax note, you'll say deferred tax, and then you're going to put these items, and you're going to put these balances and that total, and then at the end you're going to say deferred tax asset. Yeah? And they did say to you in the question that there is sufficient probable income, so we keep the assets. If they had said there isn't, we would make it a zero. We wouldn't have a balance for deferred tax. It would be zero. All right, 948. So now we can do, I'm going to do T account. You guys can do however you want. T account. T account, we start with beginning of year, which was a given, which was 20, what was the number? 30 something. 39,078. Okay. The first thing I need to do with that 39, okay, let's put the numbers in and then I'm going to leave you to do it. End of year, no, end of year doesn't go that side. End of year will go this side because it's again an asset. Do you agree? Yes? End of year goes here. End of year, what was it we just worked out? 9,408. Okay, now, the movement that's going to land up in P&L is the movement from there to there. Yeah. However, we have to split that movement for disclosure purposes into a rate change and then the temporary differences, isn't it? And in fact, once we've got that temporary differences, we're going to go back to our tax calc and check that those temporary differences are correct. Because that movement in temporary differences should be the movement that's popped out in my tax calc, isn't it? Because that's what causes it to move. So you're going to do for me the rate change. The rate change is going to change this number, and this number is currently in at 29% because last year when we calculated deferred tax, that was the rate. And now we need to change it to 28%. So the rate change is going to land up on this side because I want to make the balance smaller. And then I'm going to have a P&L, which I still think will be on this side because this side is so much smaller than that side. Yeah, so those are the two numbers that I want from you. Please. I'm not quite sure why. I'll check it though for next time. All right, is that what you got? I start with 39078, which was given. My rate change, 1348. Did you all get 1348? You divide by 29 and times by 1 to move it that way. And then the P&L is the balancing figure, 28322. Yes? Okay. So then that's required C. Required C was required B, calculate the deferred tax movement in the statement of P&L. Indicate if it's a debit or credit in P&L. It's a credit on this side. It's debit in P&L. Yeah? So number 1 is a calculation. Number 2 is a calculation. Calculations have no really required format as long as you show something which somebody can understand and you've answered the question. Yeah. Then number C is prepare the journal entries for the current tax expense and the deferred tax expense calculated in B. Let me show you some examples of journals. Let me see if I can find one for you to see. But the journal is a very basic journal. It's your journal that you remember from second year, which is just a debit to the expense and a credit to the financial position, assuming, of course, that we have a normal movement in tax. Okay, there's a deferred tax journal on page 26. There's also one on page 24. There's also one on page 22. All those examples that we had done have a deferred tax journal. And a normal tax journal, I can't see. But you know how to do a normal tax journal, right? So any of those examples we had done earlier, example 2, 3, 4, 5, they've all got examples of tax journals. Okay, so I want you to do for me the 2 tax journals. One for the normal tax. The normal tax. The normal tax is this 22318. Yeah. Prepare the journals for the current tax expense calculated in A, 22318, and for the deferred tax expense calculated in B. So you're going to do one journal for this. It's a very simple journal. And then you're going to do one for this, these two together. Yeah. Both of those, even though we call the one a rate change and we call the other one temporary differences, they both land up in deferred tax expense in the P&L. Okay, together. It's one journal. All right, so let's see. To 2318. Just make a note of that. don't do that. Yes? All right. So that's B, that's C. And then E, you can go start that tax note. We will finish it next week. We won't finish it today. But that's deferred tax then. It's the two numbers added together. The two numbers. It has to be, yeah. They both go to deferred tax expense. In fact, you'll see that the journal says deferred tax expense P&L. But in our P&L, there is no line for deferred tax expense. There's one line. It's tax expense. The current tax expense goes into tax expense. Deferred tax expense goes into tax expense. Any foreign tax paid goes into tax expense. It's all there in that one account called tax expense, isn't it? So I never put the entry to deferred tax expense, but I see that they do. So it doesn't matter really. Whether you say tax expense or deferred tax expense, it doesn't matter. And those are the numbers. All right, next week we're going to do dividends tax, and we're going to do dividends tax, and we're going to do the tax rate recon to finish that note.